Well, I finally had the chance to sit down and compile the results of the Q2 2024 earnings reports for the big six Canadian banks. Generally pretty positive performance there, despite a few challenges. Combined net income of over $12 billion for the space. So what I'm going to do in this video here is I'm going to look for some common threads and some key highlights that we saw throughout the sector. Then I'm going to go and break down each bank with key numbers, some commentary for each of those. And I want to start here with some common threads and some common trends. I want to look at four general areas. So revenues and earnings, provisions for credit losses. That was notable as it has been in the last number of quarters here. I want to look at some performance in some specific business segments and also the economic and regulatory environment that these banks are operating in. So starting off with the revenues and growth. My takeaway from the report is that despite the challenges that we're seeing in the economy in general, the sector as a whole did manage to post some pretty respectable earnings. The median earnings per share across all the banks and all sectors was in that 4.5% range. The banks benefited from a diversified stream of incomes, and that's one of the big strengths of our Canadian banks. They got strong contributions from capital markets. We're going to look at that in a little bit more detail in just a moment. On the personal and commercial banking front, wealth management front, those segments also did well. The sector overall saw revenue growth, and that was led by increased volumes, higher margins, more assets under management in their wealth management businesses. A big area, a big concern, I guess you would say, with recent quarters has been the provisions for credit losses. And we've seen those going up and up as time has gone by. And there was another notable increase across the sector in general and in most banks with one exception here. Obviously, what this shows is a bit of a cautious approach. By raising those PCLs, they're still actively managing their credit risks. They're adjusting their provisions to reflect the current economic conditions as they see them. And this also indicates that the banks are preparing for a possible deterioration in credit quality. The PCLs in this quarter were mainly concentrated in specific areas of concern. And a highlight there would be the commercial real estate, and particularly the office sector, which has been under a lot of pressure, obviously with changing work patterns, the ongoing economic challenges that space there is feeling. Common equity tier ratios. Most banks were able to raise CET1 ratios from the last quarter. This shows strong capital positions. The banks are nice and safe there. If we look at specific segments, and if we start with capital markets, the capital markets segments of the banks, we did see good, strong results here. Those were led by increased trading activity. Investment banking fees showed signs of increasing there. On the personal and commercial banking sectors, this of course is the cornerstone for our Canadian banks. We had half of the total earnings came from this segment here. The segment saw steady growth in loan and deposit volumes. When we look at wealth management, we also saw that this continued to be a major contributor to earnings. The banks benefited there from higher assets under management and increased client activity in investment products. Also, if we look at insurance, the insurance divisions performed well and they contributed to the overall mix, and all of the banks reported higher insurance premiums and better underwriting results. Just want to focus for a quick second here on commercial real estate. And we've heard a lot of concerns in the space recently. Despite this concern, though, particularly in the office space, the office sector, again, due to changing work habits, the banks did manage to navigate these challenges quite effectively. So no big red flags I saw in that space. If we look here at economic and regulatory environments, they continue to be challenging operating conditions. And it looks like the way the banks are setting up here, they're preparing for tough operating environment in 2024. They're looking at economic pressures, things like higher interest rates are persisting, inflation. These are expected to impact both consumer and business loan demand. And of course, when that happens, this could lead to slower growth in loan volumes and increased credit risk. When I look at regulatory pressures, there continues to be emphasis on adhering to regulatory requirements. And we're going to talk about one of the big banks in just a few minutes here. And I think we probably all know what kind of problems and stresses they're going through right now. But when you focus, or the banks right now are focusing on stress testing, capital planning, and maintaining the strong and robust internal controls, The regulatory environments are continuing to evolve. We're seeing the government step in and making sure that they have placed increased scrutiny on capital adequacy, on risk management practices. And as a result of some of these changes, the banks currently, they're required to maintain these higher levels of capital and liquidity, of course, to protect against any economic shocks. And from a focus on digital transformation perspective, the current environment has accelerated the need for digital transformation within the banking sector. And we've seen the big six banks, they're all investing heavily in digital technologies. They say to improve customer experiences. I think it's probably more to enhance operational efficiencies, to reduce costs, and with the adoption of AI, machine learning, to better manage risk and personalize banking services. So those are sort of the major themes that we've seen in the second quarter 2024 earnings. I do want to move now to the specific banks and go through those. But before I go there, I just wanted to thank BMO ETFs for their support of this video. And if you're looking for a smarter way to invest your money, BMO ETFs and mutual funds, they have innovative solutions for every type of investor. Whether you want to diversify your portfolio across fixed income or core strategies, or align your investments with your values, BMO Global Asset Management has the right product for you. BMO GAM's investment professionals, they have the experience, the insights, to navigate the changing markets, and then, of course, in turn, to help you achieve your goals. So don't miss this opportunity. Visit bmogam.com today. That's bmogam.com today. Discover how they can help make a difference with your money. Now, I want to shift to the earnings for each bank, and I want to start off with Toronto Dominion Bank. So some quick numbers for each of them. First of all, revenues were $13.8 billion for the quarter. That's up from $12.4 billion in Q2 2023. Earnings were $2.56 billion, down 22.6% from Q2 2023. Earnings per share were $2.04. That beat expectations of $1.85. Their provisions for credit losses were $1.07 billion. That's up 79% from $599 million back in Q2 of 2023. The bank did maintain their dividend at $1.02 per share. Their CET1 ratio of 13.4% is down from 13.9% in Q1 of 2024. Now, some of the highlights from TD Bank involve obviously the various legal and regulatory actions, the civil claims that they're facing, the lawsuits, the regulatory examinations, audits. I mean, there's just so much going on with the bank right now. We have government regulatory agencies requesting information from there. Now, the estimated range of possible losses as of the end of this quarter, they have in their report from zero to approximately $1.31 billion. Obviously, it's pretty unlikely it's going to be zero, but that's what the bank has in their report. Some reports I've seen have pegged the total amounts considerably higher than the $1.3 billion the bank has indicated in its quarterly report. It's too early to know right now with any certainty or any degree of certainty or accuracy at this point. On the anti-money laundering program investigation, the bank did set aside an initial provision of $615 million or $450 million US. That's related to the discussions with the US regulators about its anti-money laundering program. There are ongoing discussions with 3 U.S. regulators and the U.S. Department of Justice regarding the AML compliance with expected non-monetary penalties and additional monetary penalties there as well. The FDIC, there's a special assessment that they put on the books, expense of $103 million due to the FDIC's special assessment related to U.S. bank failures in the spring of 2023. There's also a restructuring charge. They incurred a $165 million charge for employee severance, personnel-related costs, and real estate optimization. And an additional $50 million in restructuring charge is expected in the next quarter to complete this restructuring program. On another topic here on the international student support, they did boost their support there. They partnered with HDFC, which is India's leading private sector bank, to offer a simplified banking experience to attract new customers to the bank there. On the wholesale banking space, they reported net income of $361 million. Revenue from the quarter was $1.94 billion, and that is a now record high. It's an increase of $523 million, or 37% from last year. Now, I want to move on to the Bank of Nova Scotia. They showed a revenue of $8.3 billion in the quarter, and that's up from the $7.9 billion they saw a year ago. Earnings were $2.2 billion. Earnings per share, $1.57. They compare with $1.68 in Q2 of 2023. Provisions for credit losses, they came in at $1 billion, up 42% from Q2 2023. They did maintain their dividend at $1.03 per share. On a CET1 ratio perspective, it came in at 13.2%, up from 13% in Q1 2024. Now, some key takeaways here as far as strategic moves are concerned. Scotiabank has basically revamped their entire strategy. This has led so far to pretty significant deposit growth. Canadian banking deposits were up 7% year over year, and in international banking, they also saw a strong revenue growth, again, thanks to better margins and a disciplined expense and capital management program that they have on there. Global Wealth Management earnings were up 8% in adjusted earnings. That was boosted by higher brokerage revenues and mutual fund fees, particularly in their Mexico segment there. For some business segment highlights, Canadian banking saw strong revenue growth, but they were faced with higher provisions for credit losses. International banking reported a substantial increase in net income. That was driven mostly by higher net interest income and favorable currency translation. Global banking and markets, they saw both higher fee-based revenues and lower credit loss provisions. Now, Bank of Montreal, they reported revenue of $7.97 billion, up from $7.8 billion in Q2 2023. Earnings of $1.87 billion, that's up 81% from Q2 2023. And on an earnings per share perspective, they reported $2.36 compared with $1.26 a year earlier. On a reported basis, provisions for credit losses were $705 million, down 31% from $1.02 billion in Q2 of 2023. The bank increased their dividend 5% to $1.55 per share, up from $1.50 previously. Their CET1 ratio, 13.4%, up from the 12.2% in Q2 of 2023. Now, for key milestones and actions taken by BMO in the quarter, Canadian personal and commercial banking, they had net income there up 6% from a year earlier, and under the total revenue category, an increase of 8% year over year. U.S. personal and commercial reported net income of $543 million, a 26% increase. Wealth management reported net income up 33% year over year, and capital markets had a 24% increase there. Strategic initiatives, they continue to focus on expense management, they say, achieving lower expenses compared with the previous year and the prior quarter. They also strengthened their balance sheet with strong customer deposit growth. BMO was actually ranked among Fast Company's list of most innovative companies in 2024, the only Canadian and U.S. bank that was recognized in that competition. Acquisition and integration costs of $26 million were recorded, and these are related to the acquisition of the Bank of the West. The last thing I'll talk about with BMO here is cutting their provisions for credit losses by nearly 31%. That does strongly suggest that they're seeing better credit quality on their books and that they're managing their risks quite well. Now, National Bank of Canada, they saw a revenue of $2.75 billion, up from $2.45 billion in Q2 2023. Earnings were $906 million, up 9% from Q2 2023. Earnings per share came in at $2.54, and that compares with $2.34 in 2023. Provisions for credit losses were $138 million. That's a jump of 62% from the $85 million they saw back in Q2 2023. They did increase their dividend 4% to $1.10 per share. Their CET1 ratio was 13.2, down from 13.5 in Q3 2023. When we look at specific segments with the bank, their wealth management segment, they saw a net increase of $205 million. That's up 15% year over year. And in their financial markets, they had net income rising to $322 million. That's a 20% increase from Q2 a year earlier. In their U.S. specialty finance and international segment, net income was $163 million, and that's a 27% jump from $128 million back in Q2 of 2023. Now, shifting to Royal Bank, they saw revenues of $14.2 billion, up from $12.4 billion in Q2 a year earlier. Their earnings were $4 billion, up 7% year over year. Earnings per share came in at $2.74, up from $2.61 a year earlier. And under the category of provisions for credit losses, they booked $920 million, up 53% from $600 million a year ago. The bank also increased their dividend 3%, now $1.42 per share. CET1 ratio 12.8%, and that is down from 13.4% in Q1 2024. The highlights over the quarter, well, one of the big ones here is the HSBC acquisition. They finalized that. So that's obviously a big win for the bank. The acquisition was completed on March 28th of this year. That adds approximately $75 billion in loans and deposits to the bank. They realized a $30 million before tax expense synergy, and they are aiming for $740 million in synergies within 2 years. They also announced the intention to repurchase up to 30 million common shares. CIBC, they reported revenue of $6.2 billion, up 8% year over year from $5.7 billion. Earnings of $1.7 billion, up 3.6% from Q2 2023. Earnings per share came in at $1.79, and that compares with $1.76 a year earlier. Provisions for credit losses, they booked $585 million. That's almost double from $295 million in Q2 2023. And they maintained their dividend at $1.62 per share. CET1 ratio is 13.1% at the end of the quarter. That's up from 13% in Q2 2023. When we look at some strategic initiatives they announced in the quarter, they are focused on the execution of client-focused strategies across their North American platforms. They did have a $13 million charge that was related to FDIC special assessment on U.S. depository institutions. So there you have it. That is the Big Six recap for Q2 2024. Do you invest in ETFs or do you invest in individual stocks? What is the best strategy? Well, we talk about that in this video. Thanks so much for watching. We'll see you in the next video.